Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for Sage5.tv, and in continuation of our real-world assets and tokenization, welcome to episode 3, where we are looking at the drivers, trends, and financial projection for this nascent niche within the crypto industry. But before I jump into episode 3, guys, please note that I am not a financial advisor. If you do require financial advice, please approach someone who is trying to give you financial advice. The information contained in this video is just for educational as well as entertainment purposes. And this content is also not targeting UK audiences for obvious reasons, of course. You are not meant to be participating within the crypto industry for the sole reason that you may end up losing your funds into investments. It is an extremely risky industry to participate in. And case in point, look at what the markets are at the time of recording. They're all red. That can happen if you don't hold your nerve, end up losing all your funds. That said, let's come back to episode 3 of our limited series, real-world assets and tokenization within the blockchain space and the crypto industry. So if you want to know what we've covered so far, you want to watch the pilot episode as well as episode 2, that I'll leave some links in the comment section, but you can also just search our channel. So let's look at the several factors or drivers that are propelling real-world asset tokenization forward. And to kick us off, you got institutional adoption. Large financial institutions like banks, asset managers, exchanges, so you're talking of the likes of BlackRock, your JP Morgan, Citi, Bank of America, and so many others, are now actively launching tokenized projects, lending credibility and scale. Examples include HSBC's Orion platform, which handled a €100 million digital bond for EIB. BlackRock not only launched a tokenized fund, but in March of 2025, it also backed a stablecoin, USDTB, that is backed by BlackRock money market shares. When giants like BlackRock, Franklin and Templeton, UBS, and Allianz participate, it signals to the market that tokenization is moving from concept to reality. This also means large pools of capital, you're talking of trillions of dollars in asset under management, could start flowing through blockchain rails in the coming years. So this is not going to be your overnight success. It's going to be over a number of years. You're talking of medium to long term. So the first driver that we're going to be looking at is the search for yield and liquidity, especially with fiat currency depreciating in double digits every year and losing purchasing power. In a low liquidity environment where banks are giving you tiny amounts in terms of interest, even though the central bank or the national interest rates are a lot higher, tokenized real-world assets offer DeFi users relatively safe yield by tapping real-world income. In 2023 to 2024, DeFi protocols integrated tokenized US Treasury bills, allowing crypto investors to earn approximately 5% on-chain from government bonds, something that drove real-world asset DeFi total value logged sharply upward. Likewise, real estate tokens offer rental yields. For example, investors are attracted to the idea of yield-bearing stable assets on-chain, especially during crypto bear market. This trend is likely to continue with more varieties of income-producing assets. Here you're looking at corporate bonds, asset-backed securities, and so forth. They will all be coming on-chain. Let's move on to regulatory clarity and government projects. Governments are waking up to the benefits of tokenization. Several central banks and regulators launched pilots for CBDCs and tokenized deposits, for example, the UK, EU, and Singapore. The UK's Law Commission produced legal frameworks for digital asset property rights in 2023, and Hong Kong's SFC set up new guidelines for security tokens. Regulatory support, such as Germany's embrace of crypto securities and Dubai's VARA regime, provides a legal path for more issuance. Notably, Hong Kong's government issued a tokenized 100 million green bond in 2023, proving out the tech in a public debt context. As regulation falls into place, the risk premium for tokenized assets falls and more conservative institutional money can then participate. All good and well so far. Next driver is the maturity of the technology. The blockchain tech stack is becoming RWA ready. Developments like smart contract-based compliance, for example, ERC 3643, allow enforcing KYC or whitelist on tokens, which is crucial for regulated assets. Oracle networks, for example, Chainlink, bring off-chain data on-chain reliably, which helps with price feeds, interest rate calculations, as an example. Interoperability protocols are emerging to let tokens move between private and public chains as needed. Even privacy solutions, you're talking of zero-knowledge proofs, are being applied so that sensitive transaction details can remain confidential on public ledgers. All this means the infrastructure to support large-scale RWA markets is falling into place now, making the projected role feasible. Moving on to market infrastructure and exchanges. In parallel, we see the rise of specialized digital asset exchanges and platforms worldwide. For example, SIX Digital Exchange or ADDX in Switzerland, a licensed exchange for tokenized securities. You got ADDX in Singapore, which is a tokenized private markets platform, and Onera, an interoperability network for tokenized assets. These platforms act as bridges connecting traditional investors to tokenized offerings. As they grow, they will provide liquidity venues and secondary markets necessary for tokenized asset ecosystems to flourish. By the end of this year, 2025, we are anticipating multiple major stock exchanges that will either partner or launch tokenization platforms. I'm talking of the likes of Nasdaq working on one for private markets. This traditional finance buy-in accelerates growth. Financial projections as of April 2025 generally foresee exponential growth. By 2025, estimates cluster in the mid-hundreds of billions globally tokenized. You're talking of the studies we looked at or the papers we looked at in our previous video. I think that was episode 2. Boston Consulting Group and Ripple, where they are estimating around $600 billion of tokenized real-world assets. Looking further, you're looking at around 5 trillion by 2027 and 10 trillion or over by 2030. Those are some cited milestones by some of the researches and papers we looked at in our previous video. If you want to know more about that, please go check in the comment section or just search our YouTube channel. And before I forget as well, if you are not subscribed and you're finding value in some of the videos that we are bringing to you guys, please consider subscribing to our channel and don't forget to click like and subscribe as well as smashing that notification bell. So to put that into perspective, even $5 trillion would be about 5% of global assets, meaning tokenization would no longer be niche but a significant slice of finance. One concrete near-term prediction though that we can make, investment firm Vanek predicts tokenized securities will exceed 50 billion in value by the end of 2025, up from approximately 12 billion or around 12 billion at the moment, essentially quadrupling in 2 years as more funds, bonds and equities come on chain. Beyond 2025, the curves steepen. If the high-end 30 to 50 trillion by 2030 scenario materializes, it implies that a substantial portion of real estate, bonds and equities globally will have representation on blockchain. It's worth noting that these ambitious projections with uncertainty, they depend on resolving legal, regulatory hurdles and on market acceptance where investors trust in blockchains and so forth. Challenges like interoperability between many chains, custodial solutions for institutional holders and clarity on investor protections will need to be addressed to unlock the higher end of this forecast. Nonetheless, even though the conservative scenarios envision trillions in value, indicating that for investors, tokenization is an opportunity set too large to ignore. Key investor implications and opportunities moving forward. From an investor standpoint like yourself and myself and many others, the rise of RWAs on blockchain creates several opportunities. So this is the time to grasp some of these opportunities. Don't let them slip through your fingers. Not financial advice, of course. Diversification into new assets. Investors can gain exposure to asset classes previously out of reach. For example, a crypto investor can now buy tokens of farmland, invoices, or private equity, assets typically reserved for large institutions. This opens up new diversification and return streams in a crypto portfolio, potentially dampening volatility by adding real-world income streams. So that would be positive exposure. Additionally, one can now invest a small amount in large assets like commercial real estate and have the option to trade tokens on secondary markets if liquidity develops. We're talking about fractional token ownership or fractional asset ownership. This contrasts with traditional investing where such stakes might be locked up for years. The ability to exit positions via on-chain marketplaces could make investing in traditionally illiquid assets more palatable. And when it comes to DeFi integration and associated yield, tokenized real-world assets can be plugged into DeFi protocols to earn additional yield or facilitate borrowing. For instance, one could deposit tokenized treasury bill tokens into a DeFi lending platform to borrow stable coins, effectively using T-bills as collateral, something impractical outside of blockchain. This composability means investors can do more with their assets, for example, earning staking rewards on a tokenized bond, and possibly capture spreads between traditional and crypto markets. And let's not forget inflation hedging, or when people take a flight to quality. During crypto downturns, RWA tokens like tokenized gold or short-term treasury tokens have appeal as they represent safer assets. Indeed, 2024 saw a trend of crypto participants moving into tokenized T-bills as a flight to quality. Thus, RWAs provide hedging options within the crypto ecosystem against purely crypto-native risks. So that's another way trying to address the sharp downturns we experience within this market, the crypto markets, during bear markets. There is now an option, take a flight to quality. Not financial advice, of course. Beyond the assets themselves, there is an investment case in the platforms and blockchains facilitating real-world asset growth. As discussed in the upcoming videos, certain public blockchains and protocols are well positioned to capture the value flowing from tokenization. Investors might consider owning the tokens of those base layer blockchains or the governance tokens of key RWA platforms. For example, we've got the MKR or MakerDAO, which I believe, if I'm not mistaken, I think it's been renamed Sky. I don't know how much that is going on, which has become a major on-chain real-world asset investor. If RWA tokenization is the next big thing in crypto, the protocols enabling it could see outsized demand investment. Again, not financial advice. Please do your own research. So like I said, we'll be looking some of these protocols and layer ones. We'll try to look at them in small size chunks. Otherwise, the videos will be longer. So watch out for the next videos to see what our thoughts are when it comes to RWAs. You may have an idea of what some of those protocols and layer ones are, but watch out for the next one. Let us know your comment in the comment section if you are gaining value from some of the content we're bringing you within this mini series on RWAs and tokenization of real world assets. Until the next one, guys, FD for Sage5.tv signing out for now. Bye.